Hello friends, in our last video we discussed the 5 broad categories of accounts and the generic 15 accounts which a small business owner should maintain. Now, how to allocate a particular event or a transaction to these broad categories, or how to identify if an account is an asset, liability, equity, revenue, or expenses, or how to debit or credit, and what are the generic rules. So for that one, as I mentioned in my last video, that I'll be covering it in the next video, in which I'll be showing the rules of accounts. So here it is. So as per accounting system, there are 3 types of accounts: personal account, real account, and nominal account. So let's understand each one in detail. So what is personal account? Personal account is relating to any person, as the name suggests. So all your debtors, creditors, or any person, any living being is treated under personal account into accounting system. Now what is the rule? Debit the receiver, credit the giver. If a person is receiving something, let's say cash, goods, anything, any tangible item, so you will debit that person, debit the receiver, and credit the giver. Opposite, if he is giving, if he or she is giving something, then you will credit the giver. As I mentioned, examples are debtors, creditors, all persons, they all fall under personal account. Now what is real account? The rule for real account is debit what comes in and credit what goes out. Whatever is coming in, you're supposed to debit it, and whatever is going out, you're supposed to credit it. If cash is coming in, you debit it. If stock is coming in, you debit it. If stock is going out, if the goods are going out, you credit the goods. If cash is going out, you credit the cash account. So all tangible and intangible assets and liabilities fall under real account. What does tangible and intangible mean? Tangible means something which can be seen, feel, and can be expressed. So you can say something which you can see. Intangible can be something which cannot be seen, but it does have a value. For example, goodwill. Now your credibility and your goodwill, it's not seen, it's you cannot show it, but it does has a value, isn't it? So tangibly it's not shown, but intangibly it does has a value. So even that comes under real account. And then all motor vehicles, your land, buildings, office furniture, all these things which you can see and feel, they all come under tangible assets. I hope I'm clear on this. If you have got any doubts so far, you can just mention it in the comments and I'll try and explain it in the best possible way. Moving on to the third one, it's nominal account. Now nominal account, the rule for nominal account is debit all expenses and credit all income. Very simple. Whichever expense you incur, you debit it, nothing else. Whichever income you earn, you credit it. All income are credited in the accounts, all expenses are debited in the accounts. Sales, purchases, expenses like salaries, fuel, rent, etc., they all fall under nominal account. Now let's understand these rules with the help of examples. It will be much easier. So the first example is, you made a cash sale of 10,000. So first a sale is made. Let's understand also. Let's also keep this side by side. Cash. Now cash is real account. So debit what comes in. Sale. Sale is a nominal account. Credit all income. You made a sale of 10,000. So the sale is made. So you earned money. So it's an income. So 10,000 will be credited in sales account as per this nominal rule. Credit all income. So your sales account will be credited. Yeah. The entry will be cash account debit 10,000 to sale account credit 10,000. So under your sales account, you will credit it. So this is debit side. This is credit side. Buys cash 10,000, and in your cash account you will debit it. Why? Because the rule is debit what comes in. You received cash, isn't it? So if you're receiving cash, then you're going to debit it. So in your cash account, you're going to debit it and say debit for what? Sale account. So your entry will be cash account debit 10,000 and sales account credit 10,000. Makes sense? Let's move on to the second example. You purchased goods worth 10,000 credit from X. Now X is the name of a person. Now again, you purchased, so that's an expense, and then credit, you purchased it on credit from X. Now X is a person, so for a person you will apply this rule: debit the receiver, credit the giver. Now X is the one who is not receiving but who is giving, so X will be credit in your books of accounts, right? So X will be your creditor. And purchases is nominal account, so debit all expenses, so purchase account will be debited in your accounts. So the entry will be purchase account debit to X account. In purchases account, X will be debited to X 10,000 and then into X account, and then you will open a creditor account under the name X, and then under X you will write by purchases 10,000. So your business owes 10,000 to X because you purchased 10,000 worth of goods on credit from X. Clear? Then moving on to the third example, you withdraw 50,000 through check from business account. So from your business bank account, you withdrew 50,000 through check. Okay. So if a owner withdraws something, it's termed as drawings. All right. So drawings is again an expense for business because business is not getting anything out of it. It's your personal account. So drawing is an expense. So nominal, debit all expenses. So you will debit drawings account, and then you withdrew from check. So money is going out of check, out of bank, right? So bank account will be credited. Why? Because bank is a real account. Credit what goes out. Now from bank money is going out, so you're going to credit bank account. Drawings account debit 50,000 to bank account. So on the drawings account it will be debited 50,000, and then on the bank account it will be credited by drawings 50,000. All right. Okay. Another example. You took a bank loan of 100K from ABC Limited. ABC Limited is a company, but obviously the companies are run by persons. So ABC Limited is a person, and then you took a bank loan. Now bank loan is kind of a money you are receiving, but it's a liability. You have to pay it off after a certain period of time or under a certain period of time. So it's a liability for your business. So it's a tangible thing. So for bank loan, this formula will, this account will apply. Debit what comes in. So bank account will be debited because you received 100K, right? And credit what goes out, sorry. And then for ABC Limited, personal account, credit the giver. ABC Limited will be credited. So you would say bank account debit 100,000 to ABC Limited, 100,000, that's your entry. Under your bank account you received 100,000, so it will be debited to ABC Limited 100,000. ABC Limited account will be a liability or a creditor in your books of accounts, and you will credit this entry by bank account 100,000. You can also say bank loan. So you know this is your liability. All right. And here also you can just mention loan. All right. Okay. Another example. Paid cash to X $5,000 for purchases made on credit. Okay. So now you are making the payment to the creditor from whom you took goods on credit. So X will be debited 5,000 to cash account 5,000. Why? X is a personal account, debit the receiver, so X will be debited 5,000. And then cash account is real account, credit what goes out. So it's going out, so credited. So under cash account, it will be by X 5,000 credited. And under X account, it will be debited to cash 5,000. If we want to relate it to the previous example of this one, you purchase goods of 10,000. Now let's say we want to do this entry into this account that we made a cash payment of 5,000. How would we do it? Against this 10,000 we would write to cash account 5,000. So the balance will be carried forward. So the balance to pay would be just 5,000. 10,000 minus 5,000. So 5,000 will be the balance, right? And then as I mentioned, under cash account, it will be credited by X account 5,000. All right, so this is how all your entries are tying up. It's very easy once you understand the basics. Now the last example, let's say if you want to make provisions of any sort of taxes in your accounts, how would you do it? Provision made for taxes, let's say for 2,000. So any provisions, any taxes which you have not paid yet, so it's a best practice to remove it from profit and loss account. And these provisions should ideally be made at the year end if they are annual taxes, right? So profit and loss account debit 2,000 because it's an expense. Nominal account debit all expenses. P&L account debit 2,000 to provision for taxes 2,000. Now provision why credited? Because it's an intangible liability. So the rule is credit what goes out. Once you'll pay it, it will be debited. So P&L account debit, provision for taxes 2,000, and provision for taxes account, it will be credited by P&L account 2,000. Let's say now you paid 2,000 through bank. So for these taxes, so what will be the entry? I'm just making another account here, bank account. So bank will be by taxes or by provision for taxes, credit 2,000, and here it will be to bank because it's paid 2,000. So at the year end, once you pay, this account is nullified, okay, and your taxes are paid, and which you already accommodated in your P&L at the year end. So these are the very basic rules of accounting: personal, real, and nominal. If you follow this one, accounting will be very easy for you. Let me know if this helped, or if you have any queries, feel free to write in the comments. Thank you very much for watching.